Hey there, Rob Schulz, Austin Smith coming to you via vlog. We've been blogging for a while, but haven't been doing much vlogging.
Right, coming at you in a new medium.
Yeah, it should be fun. And we're kind of talking about risk because that's what you wrote on in your blog this week was about the different types of risks, or two types, right?
Right. It kind of took it to two extremes. Really talking about risk and investing in money. One extreme is the risk of not wanting to lose any money at all, and to not lose any money at all, and investing is to hold cash.
Right.
And then the other extreme is not wanting to miss the opportunity to make money in the stock market. So going all in on the stock market. So kind of talking about the two extremes of investing.
Yeah, and so when we come in contact with different investors, some of the things that we notice, and I think this is just human nature, is people like to go to extremes. Mm-hmm. So we'll have a lot of people that'll come in, or they'll be in all cash because they just decided that they didn't want to take any of the market risk.
Didn't understand it, didn't want to be involved in all that stuff.
And then we'll have other people that'll come in and they'll be completely the opposite, all the way all in.
Right, and probably not really understand how much risk they're really taking.
Yeah, absolutely. And then the other thing about human nature is we'll see people that'll shift from one to the other. They'll go to cash at some inopportune times.
Right, normally backwards when you think you would want to do both.
Yeah, so we have the extremes and then switching between the two, which we think is bad.
Right, yeah, when December, January, when the stock market was hitting all-time highs, that's when people would have wanted to be in all equities in the stock market. Then when it corrects and kind of bottomed out, at least presently bottomed out in March, that's when they want to be in cash. If you're doing it right, at all-time highs is when you could pull out and go to cash, and when it recorrects to the bottoms, when you could go all back in the stock market.
Yeah, but we're talking about kind of the two extremes, and that neither one of them really gets you where you want to go.
Right. Over the long term, neither one of those are the best answer for an individual's investment portfolio. Kind of marrying those two risks together is what investment advisors like ourselves do. Get to know the investor, get to understand their financial goals. What do they want to accomplish, and then kind of their emotions around risk, to make sure they can stay the path over the long term, and then combine the safer approach with the all-out approach, and there's a medium somewhere in there that makes sense for them.
Yeah, for sure. And I can kind of see, I'm sure most people can see, that when you're in an all-cash portfolio, the risk there is the erosion compared to inflation,
right?
Which we'll see with our clients when we run basically a financial plan for them.
Right, when we're trying to plan out the next 35, 40, 50 years of their life,
right,
financially, if we don't take any investment return into account from the stock market, and we keep it all cash, and it doesn't matter if you're adding to your savings every year and you're a younger age, over a longer period of time, as expenses will increase as they always have, the inflation always wins out in the long run there.
Yeah, so it doesn't work very well. But then the other extreme is a little bit harder to understand because, we do know over a very long period of time that an all-stock portfolio will outperform any of the other investment options that we have. Mm-hmm. So what's your take on that as far as risk?
Right, so kind of the risk there is, if you look at an 80-year graph of the stock market, you're doing really great. You're up, a large percent over a long period of time, but the risk is like 2008 is what we've always talked about. Mm-hmm. But it's eventually we talked about the first quarter of 2019, the coronavirus.
Sure.
What happened in 2008? We fell 40-50%, and the first quarter for the coronavirus we've fallen something like 30%.
Oh yeah.
So investors, if they look at the long 80-year period of time, they're like always going to want to pick the one at the top, which is going to be in stocks. But, you also have to be able to stick with watching your portfolio drop by, 30, 40, 50% in a short amount of time, which most people, emotionally just can't really handle all that. So, as investment advisors, we don't want to expose them to that much risk if they're not going to be able to weather it during all seasons.
Yeah, for sure. And there can be extended periods of time where, stocks may not necessarily be completely in favor, can go 10, 20 years, and you never know when that's going to happen.
Mm-hmm.
So we always try to kind of blend in some other options. Most traditionally, we use bond.
Right.
And the bond reduces the portfolio risk, but that's not as much fun anymore.
Right. For a long period of time, bonds had offered a rate of return, an interest rate that was, it made sense to add that to the portfolio to, diversify away from all stock risk, to add some bond. But as we've gone, more and more towards zero interest rate or 0% interest rate, which is what the Fed has cut the interest rates to during the coronavirus, it's still important to have bond as a safety net and diversifying, but maybe we need a little less bond and trying to find some other innovative options to layer out different pieces of the portfolio for the most optimal long-term return.
Yeah. So getting back away from the extremes, one thing we've been doing for a little bit over a year now, is we've been using a defined outcome buffer strategy.
Right, and so it doesn't quite act like stocks on the upside, and it doesn't completely protect like bonds do on the downside. It's kind of in the middle as well, and
Correct.
It's provide a good diversifying buffered piece to kind of, it does provide us a good level of protection on the downside. But for that, we give up some upside potential. But it's definitely more of that safety piece that portfolios need.
Yeah. So we've moved into that. And then most recently, because I kind of think, when the market comes down like it did at the first of the year, it's kind of like a petri dish for us. We're able to actually see how things are happening, and it's really good. And one of the things that we started working on is a low volatility strategy with stocks.
Right. We've traditionally had some other factors in the portfolios, most namely the value, size, and momentum tilts that are in the equity piece. But all of those have traditionally been kind of the parts of the portfolio that we're trying to get the highest overall return, the highest absolute return.
Right.
And the low volatility strategy, it doesn't necessarily go after the highest absolute return. It goes after the more higher risk adjusted return. So maybe it performs in line with an index, but over a longer period of time, it takes on a whole lot less risk.
Yeah, which is different from our other tilts, because we've always said that on our other tilts, we're looking for absolute return, and then we rely on the other, like the bond, the real estate, the buffer now, to kind of bring back the volatility. But now we're starting to even try to add a tilt within the stocks themselves that's going to lower the volatility as well, make it more realistic for us.
Right, and there's a lot of funds out there that have low volatility, as part of the fund, and they're called defensive equity positions.
Correct.
But that's just kind of one of the traits, that people can, understand and like to hear that, there's a safer side of the stocks as well that's being taken.
Yeah. So risk, that's something that we talk about all the time, and whenever we're looking at our portfolios and trying to make them work a little bit better, risk is always part of the equation. So this is just kind of a deep dive into kind of some of the ways that we think about it and how we're trying to translate that into better portfolios for our clients.
Right, adding in all the different layers that correlate to different degrees, really kind of for each individual, there'll be a sweet spot kind of along that risk return curve, that they can handle and are happy with on the upside, but they can also stomach on the downside.
Absolutely, yeah. So good. Well, I hope you enjoyed our little delve into risk and the kind of some of the portfolio stuff that we're doing here recently. Like I said, we hope to kind of bring this out to you on a regular basis, in addition to the other ways we communicate. And we hope you enjoyed listening. Take care.